For the last couple of weeks, I've been addressing the primary concerns that the market prognosticators have been focusing on: inflation, lack of growth, recession, and the most often discussed, narrowing breadth. To refresh your memory, breadth is the measure of how many companies in a given index are driving the return of the index. It is often quoted that the S&P 500 would hardly be up at all for the year 2024 if it hadn't been for the Magnificent Seven. This has been described as a problem given that there are 500 companies in the index, and almost all of the returns are coming from only 7 of these companies. Digging a bit deeper into a broader definition of breadth, it can be explained by the number of companies above the short-term moving average, 50-day moving average, or the longer-term moving average, 200-day moving average, instead of just absolute return numbers for the individual companies. Last week, we saw the small cap index come to life. The small cap index, as measured by the Russell 2000, went from being flat and basically in a relative performance decline compared to its larger cap brethren, the S&P 500, to basically launching and breaking out above overhead resistance. It jumped up 6% in 2 days last week, and after a weekend of rest, continued this advance to the point that it was up 8% in only 3 trading days at Monday's close. Looking at the internal breadth of an even larger and all-encompassing index, the Russell 3000, the explosive nature of this move can be seen here with a number of different measures, all agreeing with this move higher. Ari Wald put this work together, and it is really quite compelling. Another measure that I found helpful in this breadth analysis is the internal breadth, as measured by the advanced decline line. I also find it important that non-common stocks like closed-end funds and ETFs be removed from this measure, as these do not act like normal common stocks. The advanced decline line is a measure of the number of companies advancing versus compared to the movement of all common stocks on the NYSE common stock universe. As can be seen here, this also moved aggressively higher last week. Oftentimes, it is argued that this could be a blow-off kind of move, yet as can be seen on the lower left, this percentage of companies that are currently driving these stands at only 60%. This clearly is not an as good as it gets kind of reading, as this doesn't tend to occur until a reading over 80% is seen. Notice that 60 is circled, hence it appears that this internal measure has simply been resting since December of last year and is only now breaking into strong momentum territory. Another point that I watch continuously is that of major market segments that are exhibiting market leadership. In this portion of the market advance, going back to September of last year, it has been led by the major components of the NASDAQ 100. The way that these moves can be compared is how they are moving relative to the most widely followed index, the S&P 500. As can be seen here, the pure S&P 500 upper left chart has been in an almost straight-up advance, except for its brief breather it took in late March and April. Next, as compared to the Dow Jones Industrial Average, the next most widely quoted index, it can be seen that the Dow has clearly lagged on a relative basis, yet is breaking out on an absolute basis. Next, I have highlighted the breakout points for the Russell 2000 small cap index, the EAFA Developed International Index, and the MSCI Emerging, the Emerging Markets International Index. All 3 of these appear to have bottomed out on a relative basis and are all 3 breaking out on an absolute basis. These breadth measures are quite compelling, but I also wanted to share some other observations that I have noticed. These observations are occurring while the small cap index has started this move. The most catalyzed event was the CPI reading last week, showing slowing inflation readings at the consumer level, coupled with Fed Chairman Powell's comments about how the Fed is starting to see what they have been waiting for to be able to begin cutting rates. Both of these were confirmed by a strong decline in the 10-year U.S. Treasury interest rate and a spike higher in the probability of a rate cut in September of 2024. Notice how this probability measure spiked higher in this last week. But the one that really caught my attention is the expected action out of the small cap index, the move that was started last week, according to Thomas Lee of Fundstrat. Lee brings up that when the rates initially dropped in late October of last year, a rally of 27% was sparked in the Russell 2000 over an 8-week period. Based on how long the Russell has been resting and building its internal energy, this current move, that began when the rate discussion was had last week, could take up this index 40% in 10 weeks. Wow, that is an explosive move. This is a projection by Lee, not a general opinion by most analysts. This upward advance that seems to have begun by the small cap index would be quite impressive should it reflect illustration that could be expected by Fundstrat. But more importantly, it makes me ask myself, what does the entire market tends to do when the small cap companies start an explosive advance like we witnessed last week? Clearly, this move is beginning an impressive resolution of the tight trading range that it has been locked in year to date, but this seems to telegraph internal firepower being released to fuel the next up move for the entire market. Since 1979, weekly small cap rallies of at least 5% have been followed by above average returns for both the S&P 500, as well as a continuation in the small caps over the next 1, 3, 6, and 12-month periods. To note, not only does the small cap market tend to continue its advance, but the S&P 500 tends to be even more. This table illustrates what the normal subsequent move is. In closing, I didn't want to go without mentioning the more recognizable occurrences of last week. They began with the misnaming of the leader of the Ukraine and the calling of his vice president the name of Vice President Trump. But most shocking, while I was flying back from my annual surf trip on Saturday, news of President Trump surviving an assassination attempt was reported. I sat back and said to myself, if this stuff wasn't true, it would have to be fiction. It seems, based on polling numbers, that the attempted assassination of Trump only added fuel to his fire and further increased his probability of winning the election, according to polling services. I mention this as it seems to be very positive for the market as well. So, taking it all together, I saw the small cap breakout, the unexpected attempt on President Trump's life, and the normal seasonal action of pre-election markets all seem to be collectively leaning toward further U.S. stock market advance and lower interest rates. The only thing missing could be earnings for the second quarter based on expectations. See the link in the description below. Earnings reports explained, how to understand an earnings report and why they are important. As always, should you wish to discuss your individual situation or ask any personal questions, we are always here to answer them in a timely fashion.